at the very beginning, we had the private key, right? So there were only two options. One of the most familiar options is basically I will store the private key on my computer, or I will have a Ledger Nano, right? And that will store the entire private key, right? That had a bunch of issues. One issue is that if you store it on your computer and your computer is hacked and you have a malware, it will steal your private key and the hackers will run away with all your money. Then in 2012 or so, we came out with multisig, which was a specific protocol for Bitcoin that allowed us to kind of have multiple keys that can control an address, right? And that actually solved the issue of a single point of failure.
What's going on, guys? Bang, bang. Got Michael here with me. I thought a great place to start is the current banking crisis. And obviously there is this kind of fiat world. There is a Bitcoin and crypto world. But in the fiat world, most people don't think about crisis where they store their deposits. They don't think about counterparty risk. They don't think about, what is the bank doing with my money once I give it to them? But now all of that has kind of risen up to, the surface. And now that is a topic of conversation. How do you evaluate what's happening with all of those banks and some of the problems they're running into?
Yeah, so I think we are definitely in a very uncharted territory with some of those banks, and honestly, I'm not an expert in in traditional finance, but I think even ourselves we had this exposure to SVB that luckily we managed as a company. We moved actually the assets from SVB the beginning of February, so we sort of dodged that entire fiasco. But when you think about what actually happened over there and how it plays into the narrative of crypto, the first thing is really what is the counterparty risk and what is the transparency that you have in the traditional financial system. And I think that what you said is sort of on point, that when you put your money in the bank, right, and you're seeing it in the checking account, I think most of the people, most of the population thinks that the money is over there, right? That's you basically log into your bank account, and if you deposited $1,000, they show you that you have $1,000, and people actually think that there is $1,000 in that account. They don't actually know that in order for the bank to have his business model, he's a lender, and as long as it is both in checking and saving account, right, they're basically taking this money and they lending it or they putting it to work, right? And then you are essentially exposed to their investment philosophy. You're exposed to their investment risk. And as we've seen, with SVB and a few of those other folks, that now it basically depends on their competence, the first thing, and the second is actually also depends on some what the federal regulators and what are the central banks are actually doing with the economy.
When we look at that kind of traditional financial system, it is a custodial system, right? You're giving your funds to that bank. They're obviously doing everything that has kind of now been unpacked and explained to the average consumer. Is there a world where in a fiat system, we could have a non-custodial type engagement where, yes, you could have physical cash and put it under your mattress, but are there ways that you could actually interact with some sort of financial service and have it be done in a non-custodial way?
It can exist, but it will require us to move into a system where the cash is represented on a blockchain, right? That we will actually have a natively issued central bank digital currency, and whether it's a wholesale or retail, and potentially by virtue of wrapping, even if it's a wholesale. So for the folks that are not familiar with the terminology, central bank digital currency is effectively a situation that in which the central banks, instead of issuing kind of those dollar accounts that are either in the form of cash or in the form of digital deposits that they provide to the different banks, it's basically issued on a blockchain, whether it's public or permission, but it's actually issued already on the blockchain, and this is the only place in which it is being represented. And the wholesale central CBDC is a situation that basically only the banks have access to that rail. So very similar to what is happening right now in the traditional fiat economy that, you have Bank of America and JP Morgan and, all those banks. They are the only one that have access to the Fed, and they're the only one that will have access to CBDC. And retail CBDC is actually something which is more similar to what we're seeing in China, where it looks a bit like what we are familiar with USDC and with the stable coins, that you can actually have the currency in your wallet, right? So it basically propagates to the end consumer. And there is a debate, it's actually like, a very philosophical debate on whether Western countries like the United States and Europe, which model is the right model, because you are exposed to privacy and other questions that probably people didn't care that much when they are interacting in a country like China with this. And then if it's actually just basically stops at the bank level, then the banks can use a natively issued stablecoin like USDC or Paxos or and so on to basically propagate that mechanism to the end customer. This is broadly stating that the model. And clearly, if we are moving into that kind of system, then you can have non-custodial exposure to fiat, right? In a way that doesn't require you to basically go to the ATM, withdraw the cash, and put it under the mattress, right? You can effectively have that cash truly represented on a digital ledger, on a blockchain, in the account. And then if you own the key, you own the key, and no one else can basically manipulate the assets and the fiat that is in your account.
As we look at this kind of custodial risk or this counterparty risk, obviously this has been a topic of discussion also in the crypto world as well. We've seen a number of custodial centralized services that have succumbed to bad trading, potential fraud, and a whole host of other issues. How do you look at the potential superiority of kind of this new financial system over the old financial system? Or is it actually something where there are parallel systems and the same risks actually exists in each of them? And so a user, whether you're in the traditional financial world or this new one, needs to underwrite the risk in either scenario. How do you think about that?
So in the traditional world, especially when you talk about real, like big money, or you're talking about assets that are not specifically fiat that can be represented in the form of a dollar bill, you don't have an option to go non-custodial. Okay, you have to be custodial, right? Whether you are, if you want to have, no one will, I think, unless you are, running some kind of illicit activity, you're not going to have millions of dollars sitting in cash in your garage, right? So the custodial option is probably the only option. And specifically, if you now want to interact with securities, right? So, for example, you want to have access to bonds or you want to have access to equity, then it also has to be custodial, because eventually the certificate that this government bond belongs to you sits in DTCC, which is the Depository Trust Company. It points into the custodial bank, say JP Morgan, Bank of New York Mellon, State Street, and eventually it points to some brokerage accounts that belongs to you, right? So it has to be that custodial relationship. You're not going to go to the DTCC and basically pick a paper certificate and take it home. When we think about crypto, in crypto you sort of see both models, right? So when we talk about mostly the centralized exchanges or the centralized lenders, whether it's Coinbase, FTX, I'm not putting them like in the same bucket, of course. One of them is a very legitimate and well-run business, and the other one, we know what happened, right? And we're talking about BlockFi or Celsius and some of those players. They're clearly we're running out of a custodial framework. But you also see quite a lot of activity that is a non-custodial, right? So we have the YDX, we have Compound, we have Aave, right? And those are completely non-custodial offering, right? So I think that what is actually proven is that in the crypto rails, you can choose between those two models, right? And one of them, like the DeFi protocols and the fully non-custodial, it has still some technology risks that some people and some friction, right, at least in terms of on-ramping and interaction that some people are trying to avoid, vis-a-vis the custodial relationship with folks like Coinbase or the ones that I mentioned earlier, and then you're effectively taking a very similar risk to the risk that you were taking with in traditional finance. So maybe the example that I always like to show recently is that if you look at the inception, right, of actually what triggered the bank run on Celsius, it is a very similar situation to what happened with SVB, right? Because basically the way that the bank run on Celsius started was that someone figured out that they have ETH locked in in staked ETH deposits on one of the DeFi protocols or one of the DeFi pools, and they figure out that they have a mismatch between their obligations to their retail clients, that they promise them that they can withdraw that ETH instantaneously whenever they want, vis-a-vis the fact that actually that ETH was already locked into STETH, and there was not enough liquidity to basically convert it back to ETH to issue the withdrawals. Very similar to, by the way, SVB taking those deposits and putting them in a 10-year treasury bonds, right? That if you actually wanted to withdraw that cash, then they didn't have they had maybe like enough liquidity, but they had to sell it in a really aggressive markdown, right? So it's kind of similar.
Got it. And so when you think about what you all are building, right? Fireblocks is a custodian kind of at the core, and then you guys have all this software built around it, and then you've got a number of different services that people can leverage and use on the platform. Talk a little bit as to how you've thought about building this for this new financial system, right? How do you eliminate counterparty risk, or how do you mitigate some of the risks that people have seen on other platforms?
Yeah. So the first thing that I would say is that Fireblocks is actually built. We specifically call ourselves. We don't call ourselves a custodian. We call ourselves a custody technology provider, right? And there is a reason for that nuance. The main nuance, the reason for that nuance is that we are not keeping 100% of the keys, right? At no situation, Fireblocks is basically has full control or full or you actually or our clients, right, specifically taking full counterparty risk to us. So let's assume that you're a hedge fund or you're an asset manager. For sake of convenience, that when you put your assets with, let's say, a fully custodial service out there, that custodial service has 100% of your of the keys. They basically have full control over your assets. When you are using Fireblocks basically is built with technology called MPC, multi-party computation. We've been one of the leading research organizations behind that technology, and honestly, I think we are now probably the most kind of the biggest player that is providing that technology. But the idea around MPC, similar to multisig, is that at least one of the key shares that control the wallet are with the client, right? So we can't move the funds without the client actually initiating their key. And there's one or many keys with the client, and then we keep a few keys on our end to basically put safeguards or actually run security policies to make sure that the client is not being defrauded or hacked or manipulated by either the North Korean hackers or an insider within their organization, because they can pre-configure the policies on our end. So essentially, you would say, if I'm not sending it to those whitelisted addresses, I want to make sure that there are 5 people in my organization that needs to approve it, right? And then we essentially both mitigating collusion. We are mitigating a situation in which you have people that are hacked, and then the hackers are trying to basically activate withdrawals on their behalf. So this is what we provide, kind of in a very high level from a technology standpoint.
Can you talk a little bit about kind of the state of security around this stuff and MPC and some of the like more nuanced components? Because I think what's really important is I personally, when I talk to people about this, I separate out like what is almost like the marketing message from the actual underlying technical capabilities. And the reason why I think that's important is a lot of people, when they first are like, hey, what is this asset? How do I hold it? They need the marketing message, right? They need to understand things like not your keys, not your coin. They need to understand, hey, there's self-custody. It's like being your own bank, whatever all those kind of memorable lines are. But you all are very, very technically savvy in terms of like what's actually going on with things like MPC. Can you explain that a little bit more?
Yeah, sure. So I'll maybe I can give a bit of the history, right? So initially, the concept of well, at the very beginning, we had the private key, right? So there were only two options. One of the most familiar options is basically I will store the private key on my computer, or I will have a Ledger Nano, right? And that will store the entire private key, right? That had a bunch of issues. One issue is that if you store it on your computer and your computer is hacked and you have a malware, it will steal your private key and the hackers will run away with all your money. And if you had a Ledger Nano, which is like a very secure device, the problem with it that it was offline. The problem with that was that it's a single device. So how do you work in an institutional environment where you need multiple people to approve? All those things were basically unsolved. Then in 2012 or so, we came out with multisig, which was a specific protocol for Bitcoin that allowed us to kind of have multiple keys that can control an address, right? And that actually solved the issue of a single point of failure, right? The main challenge with multisig was there were actually two challenges with multisig. The first one is that it was protocol specific. So multisig worked one way on Bitcoin. It worked in a different way on Ethereum. It works like completely different way on Solana, right? So it was very difficult to create a unified structure, a unified environment that you have basically like one protocol to rule all the different blockchains. That was issue number one. And the second issue was related to the fact that it was expensive, right? Expensive from fees standpoint, because all this logic is essentially deployed on chain. And you need to pay in order for you to operate a single key address on Bitcoin, it would be cheap. But if you wanted to operate an address that has 10 key holders, the transaction was actually expensive because of the fees. MPC solves those two problems. And the way that it works, it basically kind of takes this problem one step below and focuses on actually the encryption algorithm. And across the entire blockchains that we currently have, whether it's Bitcoin, Ethereum, Solana, Stellar, whatever it is, we have only two encryption algorithms. One is called ECDSA, the other one is called EDDSA. But for the sake of simplicity, they are basically just two algorithms. And MPC is working on those algorithms, which means that as long as you have only two implementations, you can cover all the different blockchains. And what it does, it basically creates this distributed key, right? That every one of the participants, and the participants can be humans, those can be servers, can be mobile devices, but I can essentially create a distributed key that never comes together. It never comes into one single location, but through this distributed keys and a distributed computation that is built on zero knowledge proofs, you can basically compute a transaction. So as long as a quorum of, let's say, 3 out of 5 of those devices agree, they can compute a transaction, but they never put a private key together. So you eliminate the issue of a hacker coming in and stealing all those funds from a single location. And you eliminate collusion because there is not a single employee, there is not a single person that has access to the entire private key without requiring the participation of others.
What types of organizations use this? Is this like for family offices? Are there corporations doing this? And part of the reason I ask this is many people will look at security measures, whether it's physical security, cybersecurity, whatever. And as an individual, they're like, I don't need that, right? I'm just an individual. Who would really want to take my stuff? In the crypto world, they're bearer assets. And so the kind of risk reward calculation changes a little bit. But are there very, very large, corporations, or is this for like more investors? Who's kind of the user base that you guys are seeing success with?
So honestly, we see success across the board. Let's start from actually even the retail. On the retail side, Fireblocks is not yet involved there. We're working on some solution to help there as well. But you have great companies like Zengo, you have the Coinbase wallet that they're actually using this technology for consumers. So any consumer can use this technology right now, and it will provide them protection. Then when we basically move to the institutional or enterprise or the business side, I would say it's all actually the full spectrum of users are currently using MPC and not multi-sig. Whether it's two guys and a dog in a garage that are running, two ladies and a dog in a garage that are basically running a small prop hedge fund that is trading crypto. If we're looking at big fintech companies and exchanges like Revolut and others, if we're looking at the bigger banks, Bank of New York Mellon, ANZ Bank, NAB, all those banks are also using this solution. So asset managers, big and small, are using those solutions. So it became, I would say, the standard. When we started in 2018, people were kind of skeptical about it because it was a very advanced technology that not many people fully understood how it was working. And multi-sig was quite an understood technology back in the days. But what happened over the last 5 years is that this technology almost propagated to everywhere. And almost every custodian and every provider is currently using this underlying technology.
Got it. When you see this technology that you've built, one of the other things that you guys are doing is you're basically wrapping it with developer tools. So I know that you guys just launched a whole suite of developer tools. Talk a little bit as to how you can, focus on the security, but then also add in kind of these developer tools that basically are trying to democratize access to the security.
Yeah. So I think that what was happening over the last couple of years, that we started to see a shift from people using crypto mainly for speculation, right, or for trading purposes, and the client base was mostly gravitating through around hedge funds, over the counter desk, proprietary trading firms, and so on. And in the last 18 months or so, we are seeing many more developers that are trying to build almost like real world applications, right? Whether those are NFT marketplaces, whether those we have actually a pretty cool company that is using us, that what they do, they are replacing airline tickets with NFT based tickets, right? So if you don't want, they call TravelX. So if you don't want to take the flight, you can basically transfer the NFT to someone else and they can board the flight. So you're starting to see, and I think there are a lot of applications in the marketing domain that we are seeing with Starbucks and Nike and so on, and museums and other use cases. So in all those use cases, we basically see developers, large and small, right? Some of those developers, they're already working for established brands or established companies. And some of those developers are just basically startups or people that are trying to work on some kind of POC or MVP. And what I think is quite critical over there is that in a very early stage, they will be developing on a secure environment, right? Because if there is something that we should learn from what happened from, all the hacks that we've seen in crypto in 2018, 2019, was that a lot of those hacks happened to the exchanges. And the reason why those hacks happen is that those exchanges started very small as an idea. They didn't really put a lot of emphasis on how they developing or building things securely. And then overnight, they became big, but still their underlying infrastructure for key management and custody was something that they built in-house without any controls, and then it failed, right? And I think that now we are slightly in a similar space, or a similar situation, but with developers that are building applications for really real world use cases. And what we created for them, and people can find it at fireblocks.com/developers, it's basically a set of tools and a sandbox that the developers can open an account. They can start building their application on testnet, And there's also like a very attractive package for them that they can go and start working and deploying it on mainnet. And from the beginning, they can use a very secure infrastructure for the key management, right? So basically, whether they need to generate hundreds of thousands or millions of wallets for their users, or whether they need to deploy smart contracts and mint NFTs and distribute those NFTs, they have secure interfaces, they have policies, they have all the control stack that they need from day one. And hopefully, if they are successful and their application is successful and it becomes basically something that has a very large user base, they don't need to go and re-platform, right? They don't need to go and rebuild, refactor, re-engineer the entire base of their application. They can start very small and very secure without too much uplift. And then, as it grows, the base is secure and is future-proof.
What do you think the evolution of security is going to be? Is this going to be something where people will be able to use this in a very user-friendly way, like literally on their phones, on their desktop? It'll just kind of be second nature. I think a lot about, when I use the internet, I can have a secure connection, and there's a lot of protection that's provided to me, and it's almost happening in the background. Versus right now, when I want to secure, whether it is Bitcoin or other assets, then there's a little bit of like I'm opting in mentally, right? I'm making sure that I'm doing it, and so it doesn't kind of just happen in the background. Do we eventually get there?
Yes, and I think that to a certain degree we are almost there. That was actually the philosophy of how we developed Fireblocks and our solution. And I'll give you just like my philosophy. I spent about like 2 decades in cybersecurity. So the vast majority of my career was actually in cybersecurity rather than in crypto or fintech. And I definitely agree that most people associate cybersecurity and cybersecurity control with the, McAfee or semantic antivirus that you have on your laptop, and that it basically starts running in the worst time possible, and basically your computer is stuck, right? So we sort of view convenience and security as two kind of like two extremes on the spectrum, and they don't view it something that can actually live together in a very convenient way. One of the only examples of a company that was really able to do it well is Apple with iOS and the iPhone, right? So if you look at what Apple did, and they done a pretty amazing job, is that when they came up with an iPhone, they actually came up with an amazing user experience. But iPhone, one would argue, is also one of the most secure devices on the planet, without asking the user to like how many people that they have an antivirus on their iPhone, right? There are basically very few. There are actually no proper today, there aren't very sophisticated antivirus software for iPhones, right? It's not that it's not that it has zero vulnerabilities, but they took a lot of very interesting steps, both on how they build the entire hardware, how they build the entire software, and how they build the entire ecosystem through the App Store to find the sweet spot between exceptional user experience and high level of security. I think that there is a huge opportunity to mimic the same approach with crypto and blockchain. And the main reason is that the underlying signal or the underlying technology for blockchain is already built on security, right? Basically, it's all cryptographically secure. If you look at Bitcoin and Ethereum as a blockchain network, right, it was never hacked, although it is the biggest honeypot on the internet. So the solutions that are built on top of it, whether those are the custody solutions, the wallets, the way that we interact in peer-to-peer transactions, there is a huge opportunity to make it very seamless, and that people won't need to think about, hey, like, did I back up the key? I didn't back up the key, so on. And I think it's the job of all the people that are working on those solutions, including ourselves.
Talk to me about the bear market. As you've gone through this bear market over the last, let's call it 18-ish months, maybe 15 months, whatever it's been now, are you seeing more of a drive to the custody products, and what we have seen is people pulling assets off exchanges. So I'm assuming that they're going more into kind of self-custody and non-custodial products, but are you guys actually seeing that in the kind of customer flows?
Yeah, well, so the week after FTX collapse, we've seen something like $10 billion inflows, right, from people pulling assets from exchanges into the kind of direct custody infrastructure. And we're also working very hard right now to create solutions where, at least for institutions, they can still basically allocate and trade and take positions on exchanges, but they don't need to take the full counterparty risk and pre-fund on the exchange. So there's definitely a lot of push towards that as well. I can also say that when you talk with a lot of the consumer-based wallets, people like Zengo and Ledger and so on, they also, like the months after FTX has been the best months that they ever had in terms of product adoption and new users. So yeah, overall, I think that there is definitely larger appetite, and there is full recognition of counterparty risk and quality systems and both figuring out that you don't expose yourself to mismanagement of your assets by a third party, and also that the technology under the hood is safe and secure. People are asking way more in terms of what are the certificates, what are the certifications that you have, what are the governance and controls that you have in terms of developing the solution. For example, we worked really hard to achieve something that is called CCSS Level 3, which is, we are currently the only one that are holding that certification, which is a dedicated certification for cryptocurrency wallets. So people sort of looking into all those aspects. I will also say that people talk a lot about the fact that it's a bear market right now, and probably it's true given the activity, volatility, price point. But as a company, we went through the 2018 bear market, and I think it's very different now.
As we watch this all continue to play out, regulation is a big piece of it. Do you think that self-hosted wallets, non-custodial wallets, whatever you want to kind of use the nomenclature, do you think that those could potentially come under even more scrutiny, or possibly in the extreme example be banned in the United States?
It's an amazing question. And I think that the pendulum is sort of continuously swinging between both sides of that spectrum. I think I actually got appointed few weeks ago to be on the technology advisory committee of the CFTC, and we had a session over there earlier this week. And the self-hosted wallets was one of the topics. I think that the sensible part, or the sensible regulators, and also the sensible legislators, Congress people, and so on, they view self-hosted wallets as a mandatory part of the ecosystem. So it's hard to see how those can be absolutely banned. And it's hard to basically underwrite the narrative of why they should be banned. There is a confusion on the regulatory side that somehow assumes that if you introduce self-hosted wallets or unhosted wallets, you undermine specifically anti-money laundering and the ability to basically trace down illicit activity. That's actually was proven to be not true, right? You can, because the blockchain is somewhat transparent and transactions are trackable. It's true that it's harder to freeze those assets in some cases, especially when we talk about kind of native assets like Bitcoin and Ethereum. But it's probably more interesting if the regulators will kind of switch the kind of the view on this, and will say, okay, most of we believe that the future activity is actually going to be in, let's call it tokenized assets broadly, but whether those are NFTs or stablecoin or tokenized securities or whatever, right? And then you can actually build a very interesting compliance logic into the asset itself, into the smart contract. And then it's actually agnostic to whatever it moves in hosted wallets or unhosted wallets. But I think it will be very, very difficult for the regulators to ban unhosted wallets, especially given the narrative that we have right now that counterparty risk is important. Fully custodial services, they have their own vulnerabilities, and people should have the option.
What are you most excited about internally?
So I'm super excited about us kind of seeing a lot of the newer use case coming to fruition that we've been working on with partners. I think that our investment in working with payment service providers, banks, merchants, and so on the utilization of stablecoin for transforming the core financial rails, and probably the simplest property of payments between people is starting to pan out. And I think in the next 12, 18 months, we'll see a pretty significant explosion on that as being one of the killer use cases, especially as it comes to cross-border transfers, micropayments, creator economies, and so on. So I'm very excited about that. I'm excited about the use cases around, broadly speaking, Web3 that are sort of when you go into the non-financial markets, like gaming companies, brands that are using it for loyalty points, and we're putting a lot of investments over there. And last but not least, this is a bit of a longer, I think, horizon, but some of the works that we have around really the core capital markets, it's slower in the US, but especially in Europe and more so in APAC and Africa, where you see governments really thinking about crypto rails as the rails for the future of capital markets. I'll give you a quick example over there. We're working on a project with the Tel Aviv Stock Exchange. So the Israeli government is currently working on issuing their treasury bonds on a blockchain, right? So those are kind of very, I think, futuristic projects, but we're starting to see those things panning out.
As we look kind of moving forward, if people want to find out more about the business, if they want to come potentially work with you guys, if they want to become users, where can we send them to find more about Fireblocks?
Our website, so fireblocks.com. That's probably the place where they can start in terms of exploring what we do and getting in touch with us.
And then are there any types of roles that you guys are actively trying to fill right now, or any types of people that you're looking for?
Yeah, we're mostly currently focusing on both customer services roles, and we are also focusing on in some of the basically R&D areas where we are hiring.
And then where can we find you on the internet?
So on my LinkedIn, Michael Shaulov, and can email me at michael@fireblocks.com.
Awesome. Michael, listen, thank you so much for taking the time to do this. Obviously, self-custody has become a huge topic of discussion. Counterparty risk, both in the legacy fiat system, but also in the crypto system, still remains top of mind for many people. You guys have done a great job building a technology that obviously a lot of people find valuable and continue to use today. So congrats on all the success, and we'll definitely do this again in the future as you continue to build out further.
Thank you so much, Anthony.